Hey guys, welcome to the weekly wrap up. And this week we do have higher interest rates as we round out the end of the week. We are up about an eighth to a quarter% from where we started. And unfortunately, February has just not been very kind to us for interest rates. However, we do believe that as we go into that first week of March and we get new jobs numbers and unemployment numbers the first Friday of March, we should see some improvement. We also have a really important inflation indicator, which is happening on March 11th. And that is one where we expect to get some good reprieve on interest rates as well by looking at year over year and what we expect that inflation number to be. So there should be brighter days ahead, but this is where we are today. The other thing, guys, that I really want to make sure that we talk through and that you guys know about is after April 15th, for any closings that are happening after April 15th, on average, conventional interest rates for clients will potentially increase an eighth to a quarter to potentially 3/8 of a point. Now, why is this happening? Fannie Mae and Freddie Mac have come in and announced that they are maneuvering around their loan level price adjusters. So what in the world is a loan level price adjuster? What it does is it basically takes into account a bunch of different criteria: debt ratio, credit score, if you're buying a single family residence, if you're buying an owner occupied, non-owner occupied condo, if you're putting 5% down, 10% down, 15, it basically takes all those components and assigns a risk. So it's the reason that sometimes people with a 740 credit score on a conventional loan with 5% down have one interest rate, and people with a 680 have a different interest rate because that risk assessment on that lower credit score is higher. That all makes sense. What doesn't make sense is what Fannie Mae and Freddie Mac are doing now on their loan level price adjusters, because what they're doing is they're actually increasing the loan level price adjusters for some of our more better credit clients. So it just doesn't really make sense. So who does this impact? This will impact buyers that are buying after April 15th for us. The challenge is other mortgage companies will do it differently. Some will already have this priced in, but this is how we're doing it. So make sure you check with who you work with in general, or if you work with us and you have other options, check how they're doing it. It's important. Also, it only affects conventional loans. It does not affect jumbo, does not affect VA, USDA, or FHA. So it is just conventional. So I'm going to share my screen and let's take a really quick peek at what some of these adjusters are doing, and you can see them. So these are the adjusters that will happen after April 15th. And as you guys can see, anything in red is going to actually increase the interest rate. Anything in green will actually improve the interest rate. So it's not all bad. But the challenge is, if we look over here, these are all credit scores. Fannie and Freddie made a whole new credit tier. 740 used to be the highest credit score on conventional financing. Well, they added a whole new tier of 760 to 780 and then above 780. So that is challenging because most clients, some have really high credit scores like that, but in general, most fall somewhere between 735 to about 760. So that is the majority of the increase in rate. So if I am at a 740 credit score and I am doing 20% down, the loan level price adjuster will be almost 1%. Now that is not equivalent to interest rate, but it probably is equivalent to about a 1/4% in actual interest rate. If I am putting 5% down or 8% down, my adjuster will be 0.625. So probably closer to an eighth or a quarter. But what's interesting is that those are really good credit scores. So if I look over here, let's say I look at a 680 credit score, if it's gray, that will have no change in the interest rate. And if I have a 680 credit score and I'm doing 20% down, that adjuster goes up quite a bit. It's going to still be expensive, but between a 660 and a 680 with 20% down, that actually improves. So it's really baffling to me on some of the changes that they're doing and why they're doing them, because it seems like we're almost, hindering some of the better credit scores, and we're actually improving the rates of some of those other credit scores in this 660 to 680 range. It is what it is. I am just here to report it, not clearly to understand it. The other thing, guys, is over here, that's a new change, is when we look at debt ratio. Before, we always said, well, at least if it approves and there are 45 to 50% debt ratio, we don't really care, because it didn't have impact on the interest rate as long as it approved. But now there is an additional hit for any debt ratio greater than 40%. So these would be added on 0.375, 0.375, 0.25%, pretty much across the board. And so what that is going to do is it's going to have impact, and it's going to be adjusting interest rates now for debt ratio. And so before, when we didn't have to always get all the documentation to show bonus because they qualified for what they wanted, and it didn't really matter because they had great credit and we didn't need to document that extra income. Well, now we're going to want to document that extra income because it could affect their interest rate. The other thing that I think is going to be really challenging is when people are searching or trying to find out what general interest rates are and trying to compare, it's going to be really challenging to do so, because now there are so many different adjusters that are going to come into play. And debt ratio is one that sometimes, until you're really close, until you have a house, it's hard to nail it down. And so they might get into something and the lender might say, oops, sorry, now we got your updated stuff and your debt ratio is this, and now your interest rate just went up. And that is going to be really, really frustrating for consumers. The other thing that I think is really important, and I'm going to share my screen for this one, is lots of people will go to Mortgage News Daily. A lot of realtors go to Mortgage News Daily and look and kind of gauge interest rates. So this is Mortgage News Daily today, but if I scroll down, it also will compare Mortgage News Daily, Freddie Mac, and the Bankers Association. So guys, even here, Mortgage News Daily says a rate of 6.82, Freddie Mac says 6.5, and the Mortgage Bankers Association says 6.625. All three of those are different, but the question that I would have is, what are they using for a credit score? What are they using for a debt ratio? And how are they coming up with these averages? And so I think what's going to be really challenging as we go forward is that these sites are going to really confuse the consumer, because these sites might show lower credit scores than what we are telling clients, and they're not going to be very happy about it. But because these sites don't factor in any of those adjustments that I just went through with you. So the reason that I'm sharing all of this with you is, number one, if you have clients that are looking at sitting on the fence, get them off the fence, because this could have a big effect in their interest rate and qualifying. If you have clients that are looking at closing early April, maybe later April, make sure they know what the potential difference is, because there are some clients that will benefit to closing after April 15th. There are some that will definitely have a worse position if they close after April 15th. It depends. Right now, we are pricing both options so that the consumer knows what their option is if they close before or after. But most importantly, guys, it is going to be harder for clients and you guys to maybe see what are those average interest rates, because now there are so many factors that will go into it. It'll be really, really challenging for people to really use those generic sites to calculate it out. If you have questions, I know this was long. If you guys have questions, let me know. I'm happy to chat with you. Like I said, every client, we're looking at both options, and all of this stuff is public record. You can look online, you can Google it, Fannie Mae LLPAs, all the data is there. but it's one of those things where it's just a lot for everyone to digest and to make sure that people get the right info and the right data. Let us know if you've got questions. We'll talk to you soon.